continues at Twitter. The new owner, Elon Musk, has raised the possibility of the social media platform going bankrupt.
Banks including Morgan Stanley and Bank of America say they'll loan him $13 billion. Equity investors like Oracle co-founder Larry Ellison and Saudi Prince Al-Walid bin Talal are set to chip in $7 billion.
The world's richest man, Elon Musk, has started liquidating assets to help fund his bid to buy Twitter.
Elon Musk recently acquired Twitter and has been making headlines around the world. However, Twitter's ad revenue, which makes up 90% of its revenue, has slowed down due to some of the biggest brands pausing their advertisements on the platform. Additionally, there has been controversy surrounding the company's employee management. The situation has gotten so bad that Elon even warned of going bankruptcy. But while most people were focused on these dramatic headlines, few were paying attention to the genius financial strategy that Elon used to acquire Twitter. And this strategy is called a leveraged buyout, and it is very risky. If everything goes well, Elon will make billions, but if Twitter goes bankrupt, it could shake the entire American market. Let's first examine how Elon financed the deal. He used $24 billion of his own money by selling Tesla stocks, and raising $7 billion from his friends Larry Ellison and the Saudi prince. And lastly, he raised $13 billion from banks, and $6.5 billion of which was for the leveraged buyout. But what exactly is a leveraged buyout? Imagine a wealthy man named Samir who wants to acquire a social media company called Tweet. He needs to spend $10 billion to acquire it, but although he is worth $100 billion, he doesn't have the actual money to buy the company. This is because $100 billion of his net worth is in stock value. So instead of selling his stocks, he puts in $5 billion of his own money and takes out a loan for the remaining $5 billion of the acquisition. Now, in a normal loan, Samir would pledge his shares to the bank as collateral. If Samir is unable to pay back the loan, the bank would take ownership of his shares and sell them to recover their money, plus interest. However, in a leveraged buyout, the loan is not in Samir's name, but in the name of his company. And instead of pledging his own stocks as collateral, he pledges the factories of his company. This is how a leveraged buyout works, and this is what Elon did with Twitter. There is another catch to this strategy. The banks knows that the $5 billion loan to Samir is a very big risk, so they come up with their own strategy to minimize this risk. They don't give the loan entirely with their own money, but rather sell the loan in the form of bonds. For example, let's say the bank is called Bank of Richest. This bank issues a $5 billion bond with a 10% yield, and the bond is split into 10 units with each worth $500 million. 10 smaller asset management companies called A, B, C, and so on buy these units for $500 million each. So the bank is charging Samir a 15% interest on the loan, but is only giving a 10% interest to its investors. At the same time is making a huge profit of 5% on a $5 billion loan without actually giving out $5 billion. If Tweet goes bankrupt, the Bank of Richest will not fail because it never actually gave out its cash. Instead, it will take control of Samir's pledged shares, sell the collateral, and recover its money. And left money will be passed to those management companies. So, just like the Bank of Richest in Elon Musk's case, there are 7 banks who have given out a loan of $13 billion. So just like the Bank of Richest took a very, very risky bet here, these banks are taking a very, very risky bet. But now the question is, how can this strategy could put a dent on American economy? Well, guess what? These scenarios are only meant for ideal market conditions. But in case of Twitter, there's a big problem. You see, guys, the moment Elon came in, he started making all these changes. He started to make headlines all across the world. And because of these radical changes, giant advertisers like General Motors, Volkswagen, and Audi has stopped their ads. On top of that, top-level employees have left the company. The $8 plan have also failed, and the entire company was losing $4 million every single day. So now, while the banks were selling one bond unit for $500 million with a promise of 10% in return, after looking at the state of Twitter, the smaller investors are not willing to buy these bond units at all. So you know what? The banks had no other option but to decrease the cost of this bond unit. So they decreased it from $500 million to $450 million, then to $400 to $350 to just $300 million. But the return still has to be the same 10% dollars, because that is how the bonds works. So now the investor who would buy this unit at just $300 million would get a 10% return, which means what? If these banks had sold the units of $500 million as expected, they would have got back the entire loan amount of $5 billion. But now, since the same bond unit is being sold at just $300 million. Now with this scenario, they'll be able to raise only $3 billion from bonds. So this way the bank will have to risk $2 billion of their own cash. Now here are two possibilities. Number one, if these loans are lent on a fixed interest of, let's say 15%, then even if Elon is charged a 15% interest, the banks would be paying a higher interest rate than 15% to the investors if they sell the bond units at $300 million. So here the banks will clearly incur a loss, right? And the second possibility is with the floating interest rates. So in this deal, let's say the banks have to pay a 17% interest on their bond units. Now what they would actually do is they would increase the interest of Twitter loans to 20%. Then again, if the bond yields touch 20%, they could increase the interest to 22% to 23% or to even 25%. And that means if there is more negative news about Twitter, Elon will have to bear high interest rates. So if everything goes well, Twitter will become profitable. Elon will pay back the debt, the bank will suffer minimum losses, and the investors who bought this debt will make a ton of money. But if Twitter fails, it could lead to a domino effect, whereby first the entire bunch of banks would suffer billions of dollars of losses, their stocks might plummet, and considering the upcoming recession, if any one or two of these banks go bankrupt, it's going to be a nightmare not just for Elon Musk, but also for the American economy.